Hi there, it's Friday the 26th of April 2019. I'm Steve Towers. Welcome to ITB, coming to you today from New York City. Let's get started. In India, a government committee has recommended that the country adopt a formula-based approach for determining the profits attributable to a business connection, which is a domestic law nexus rule, and to a PE, the treaty-based nexus rule. The formula-based approach includes a significant weighting for sales in India. The Central Board of Direct Taxes has invited public comments on the committee's report. The deadline for such comments is 30 days after the publication of the report on the Income Tax Department's website, which should mean that the deadline is the 18th of May. For a copy of the board's announcement and the committee's report, please go to our website or app. As I've noted, the Indian income tax law uses the concept of business connection as a nexus test for determining whether a non-resident is subject to income tax. If a non-resident does have a business connection in India, but its business is not conducted exclusively in India, Indian income tax will be imposed on that part of the profits which are attributable to the business activities carried on in India. To determine that amount, the non-resident is required to maintain books of account and financial statements. However, in the words of the report, where such books of account are either not maintained or it may not be possible to determine the actual profits from such books of account, the assessing officer can resort to secondary options prescribed in Rule 10 of the Income Tax Rules. Rule 10 says this: in any case in which the assessing officer is of opinion that the actual amount of the income accruing or arising to any non-resident person, whether directly or indirectly, through or from any business connection in India, cannot be definitely ascertained, the amount of such income for the purposes of assessment to income tax may be calculated 1. At such percentage of the turnover so accruing or arising as the assessing officer may consider to be reasonable, or 2. On any amount which bears the same proportion to the total profits and gains of the business of such person as the receipts so accruing or arising bear to the total receipts of the business, or 3. In such other manner as the assessing officer may deem suitable. As you can see, Clause 1 and Clause 3 both allow a wide discretion to the assessing officer. In contrast, Clause 2 adopts an objective formula, but it does require the determination of the total profits and gains of the business. In practice, Rule 10 is used not just for the domestic law issue of determining the profits attributable to a business connection, but also for the purpose of determining the profits attributable to a PE under Article 7 of a double tax treaty. In India's view, resort to Rule 10 is permitted under treaty provisions which correspond to Article 7.4 of the UN Model Treaty. Insofar as it has been customary in a contracting state to determine the profits to be attributed to a permanent establishment on the basis of an apportionment of the total profits of the enterprise to its various parts, nothing in paragraph 2 of Article 7 shall preclude that contracting state from determining the profits to be taxed by such an apportionment as may be customary. The method of apportionment adopted shall, however, be such that the result shall be in accordance with the principles contained in this article. As you know, an identical provision was included in the OECD Model Treaty up to the 2008 edition. The government's desire to reduce the wide discretion in Rule 10 and to make the profit attribution determination more objective and therefore more certain was the context for the committee's work. But the government's agenda is clear from paragraph 2 of the committee's mandate. Examine the contribution of demand-side and supply-side factors in profit attribution. As we'll see, the committee's recommendation is that a mix of demand-side and supply-side factors should be used. The committee starts its analysis by distinguishing between three different versions of Article 7 in the major model treaties. Firstly, there's Article 7 in the 2008 and earlier editions of the OECD Model Treaty, which I will call Article 7 OECD 2008. Secondly, Article 7 in the 2010 and later editions of the OECD Model Treaty, Article 7 OECD 2010. And thirdly, Article 7 in the 2017 and earlier editions of the UN Model Treaty, Article 7 UN 2017. The committee identifies some important differences between these three versions. Firstly, the provision which allows the customary use of an apportionment method is included in Article 7 OECD 2008 and Article 7 UN 2017, but it's omitted from Article 7 OECD 2010. Secondly, in regard to Article 7.2, which sets out the general rule for how to attribute profits to the PE, which is based on the separate and independent enterprise hypothesis. In Article 7 OECD 2010, the transfer pricing factors of functions, assets, and risks are included in Article 7.2. For the purposes of this article, the profits that are attributable in each contracting state to the permanent establishment referred to in paragraph 1 are the profits it might be expected to make, in particular in its dealings with other parts of the enterprise, if it were a separate and independent enterprise engaged in the same or similar activities under the same or similar conditions, taking into account the functions performed, assets used, and risks assumed by the enterprise through the permanent establishment and through the other parts of the enterprise. Whereas there is no reference to these factors in the corresponding provisions in Article 7 OECD 2008 and Article 7 UN 2017. Subject to the provisions of paragraph 3, where an enterprise of a contracting state carries on business in the other contracting state through a permanent establishment situated therein, there shall in each contracting state be attributed to that permanent establishment the profits which it might be expected to make if it were a distinct and separate enterprise engaged in the same or similar activities under the same or similar conditions and dealing wholly independently with the enterprise of which it is a permanent establishment. It's clear that the committee doesn't like Article 7 OECD 2010. Although they identify some other differences between the three versions of Article 7, it's the omission of the customary use of apportionment and the express reference to functions, assets, and risks, which the committee finds objectionable in Article 7 OECD 2010. Let me quote at some length from the report. The most significant change introduced in Article 7 in the 2010 update of OECD Model Tax Convention is the introduction of functions, assets and risks, or FAR analysis, as the basis of the profit attribution, which was not there earlier. This change was significant from two different perspectives. First, it approximated the process of profit attribution with that of transfer pricing, thereby leading to an illusion that both of them are one and the same and can be undertaken in an integrated manner by a common FAR analysis. The second and the far more significant impact of this revision, particularly from the perspective of market jurisdictions, was to ensure taxation of profits solely on the basis of the contributions made by supply-side factors, while completely ignoring sales and thereby the contributions made by the maintenance of the markets and the demand-side factors to profitability of a foreign enterprise. By attributing profits only on the basis of FAR, representing supply-side factors, and excluding sales from the equation, the contribution of market jurisdictions to the profits derived by an enterprise from that jurisdiction stand completely ignored. The other extremely significant change introduced by this revision was to omit the option of determining attributable profits by way of apportionment, as may be permissible under domestic laws. This option, which existed in the paragraph 4 of the Article 7 of the Model Tax Conventions till then, was omitted from the revised Article 7 of the OECD Model Tax Convention. The practical significance of this change was that even in cases where accounts were not available or where they were not accurate, the determination of attributable profits was to be done by taking into account function, assets and risks, and more importantly, without taking sales into account. The combined effect of these changes has the effect of integrating transfer pricing and profit attribution into a single FAR-driven exercise and omitting the option of profit attribution by apportionment. The most important effect of these changes, with immense consequences for all market jurisdictions, including those in developing countries, is the exclusion of sales as a basis for attributing profits. Given its importance in changing the balance of taxing rights between the country of source and the country of residence, it becomes essential to examine the implications of this change on the distribution of taxing rights and inter-nation equity, with reference to the basic tenets of public economics, tax policy, and relevant literature. And for the next few chapters, the report does exactly that. The committee finds support for using sales as a basis for profit attribution in economic theory, practices of some other significant jurisdictions, and views of some prominent academics. Let me briefly give you the committee's conclusions on each of these sources of support. In regard to economic theory, the committee concludes in this way. The committee observes that business profits are contributed by both demand and supply of the goods, and hence a jurisdiction that contributes towards demand by facilitating the economy and the ability of their residents to pay, or by maintenance of markets that enable sales, as well as the jurisdiction that contributes to the production or supply of goods, contribute towards the business profits of the enterprise. This gives rise to a valid justification of taxation by them of the profits to which their economies have contributed. Where the economies of both contracting states in a tax treaty contribute to the business profits, there exists sufficient economic justification for profits to be allocated among them in a manner that avoids double taxation. The committee states that the use of sales as a factor in apportioning profits is currently applied or proposed in these significant jurisdictions. The EU. This is the European Commission's proposal for CCCTB, the Common Consolidated Corporate Tax Base. The US. According to the committee, all of the US states which impose an income tax, 46 in total, use sales as a profit apportionment factor, and a majority of them use sales as the only profit apportionment factor. And, would you believe it, China, in regard to its deemed profit method. And in regard to the views of prominent academics, the committee finds support for the use of sales as a profit apportionment factor in the writings of Klaus Vogel, Peggy Musgrave, Joseph Stiglitz, Reuven Avi-Yonah, and Ulrich Schreiber. The committee recommends that Rule 10 be amended to adopt these formula-based approaches for both domestic law business connection profit attribution and treaty PE profit attribution. I'll take you through each of these in turn. The standard approach uses this formula. Although it looks a little daunting, it's actually quite straightforward. The first step is to calculate PDFI, the profits derived from India. This is calculated as the revenue derived from India, which should be easily ascertainable, multiplied by the global EBITDA percentage of the enterprise, not the group of which the enterprise might be part. However, to guard against the possibility that the enterprise derives very low profits on a global basis, or perhaps even losses, there's effectively a minimum EBITDA percentage of 2%. Having calculated PDFI, you then apportion that amount to India and outside India according to 4 factors, which have different weightings. The first factor is sales, which has a weighting of 1/3. The second factor is number of employees, which has a weighting of 1/6. The third factor is wages, which also has a weighting of 1/6. And the fourth factor is assets, which has a weighting of 1/3. And that gives you the amount of profits which are attributable to the operations in India. Here's a simple example. Please hit the pause button if you'd like to study this. I've called the second approach modified approach if a significant economic presence, SEP, exists by virtue of the number of Indian users, and there is a low or medium user intensity business model. As you know, India has amended its income tax law to widen the business connection nexus. A business connection will be deemed to exist if a non-resident enterprise has a significant economic presence, SEP, in India. Yes, this is a possible model for the third proposal in Pillar 1 of the OECD's consultation document on digital taxation. Under the legislation, a SEP will exist if either of 2 thresholds is satisfied. A threshold based on Indian revenue and a threshold based on the number of Indian users. The legislation describes this second threshold as systematic and continuous soliciting of its business activities or engaging in interaction with such number of users as may be prescribed in India through digital means. Unfortunately, even though the amendment is already effective, the government has not yet indicated the numbers for the 2 thresholds. If a SEP exists by virtue of the number of Indian users, the committee recommends that a modified version of the standard approach should be applied to reflect the contribution of users. If the enterprise has a low or medium user intensity business model, then the formula will be this. If you compare this formula with the formula for the standard approach, you will see that the weightings for sales and assets have been reduced from 1/3 to 0.3. The weightings for employees and wages have been reduced from 1/6 to 0.15. And a weighting of 0.1 has been added to reflect user contribution. I've called the third approach modified approach if a SEP exists by virtue of the number of Indian users and there is a high user intensity business model. The formula for this third approach is very similar to the second approach. The changes are the weightings for employees and wages have been reduced from 0.15 to 0.125. The weighting for assets has been reduced from 0.3 to 0.25. And the weighting for user contribution has been increased from 0.1 to 0.2. However, note that the weighting for sales remains unchanged at 0.3. And I've called the fourth approach special rule if the business connection or PE in India is constituted by the activities of an Indian resident associate enterprise. A typical situation where this would occur is where an Indian subsidiary in the group creates an Article 5.5 agency PE for the non-resident enterprise. Yes, this is the familiar and controversial issue of whether the arm's length fee paid by the non-resident enterprise to the agent causes the profits attributable to the PE to become nil. Under this special rule, the answer will generally be no. The special rule requires the profits attributable to the business connection, or PE, to be initially calculated in accordance with the first three approaches. And then the fee which is paid by the non-resident enterprise to the Indian resident associate enterprise is deducted to determine the final amount of profits which are attributed to the business connection, or PE. The report notes this. For this purpose, the employees and assets of the associated enterprise will be deemed to be employed or deployed in the Indian operations and located in India. I should also note that there is a proposed de minimis exclusion. Let me give you a few comments in regard to these aspects of the report. My first comment concerns the implications which the report has for both the current global work in regard to digital taxation and for transfer pricing analysis under Article 9. The report does not indicate that there would be any such implications. Strictly speaking, the report is limited to business connection situations under the current law and PEs under the current treaties. Therefore, although the SEP Nexus rule is within scope of the report, that is merely a domestic law nexus rule. Under current treaties, the SEP Nexus rule is irrelevant. And the report does not indicate that its approaches could be adapted to apply for transfer pricing analysis under Article 9. However, I would have to think that the report provides a good illustration of how the SEP proposal under Pillar 1 of the OECD's consultation document on digital taxation might work. And if that's the case, an extension of the report's approaches to the Article 9 situation would seem feasible. If matters were left as they are now, there would be a source country bias in favour of Article 7. In other words, in most cases, the report's approaches to the attribution of profits to PEs would lead to a higher amount of profits falling within the Indian tax net than would be the case if there were no PE and the analysis was confined to an Article 9 transfer pricing analysis. That to me sounds unsustainable. The report's approaches will apply only through the application of Rule 10. And Rule 10 can apply only if the non-resident enterprise does not prepare books of account for the business connection and or PE, or if it does produce such books of account, they are considered to be inadequate. This means that from a practical perspective, the report's approaches will generally apply only to so-called accidental PEs. In other words, the non-resident enterprise did not intend there to be a PE. In those situations, books of account would be unlikely to be prepared. The report's approaches result in the calculation of profits attributable to operations in India. The calculation starts with revenue derived from India. At no stage do the book versus tax differences, both permanent and timing, in the Indian income tax law are taken into account. So it looks like the report envisages that book versus tax differences will not be adjusted for. The report's approaches apply a fractional apportionment as opposed to formulary apportionment. The report says this: fractional apportionment is permissible under paragraph 4 of Article 7. In essence, it differs from formulary apportionment followed by the US states and proposed by EU, in that it does not necessitate consolidation of profits of the enterprise from different tax jurisdictions, and can be determined by determining only those profits that have been derived by the enterprise from India, and thereafter apportioning them on the basis of certain factors. This approach is also permissible under Rule 10, frequently applied in India, and in principle has been upheld as being permissible by the Indian courts. There's been only a few public developments this week in regard to digital taxation, although I'm sure that there's a lot of activity happening behind the scenes in preparation of the work plan, which is scheduled to be presented to the G20 finance ministers on the 8th of June. A US Treasury official was quoted as saying that at this stage, it's not clear whether that work plan will narrow down the options. Meanwhile, in regard to unilateral DSTs, we've had 3 developments worth noting. The Czech Republic government has indicated that it is currently working on a DST. It's been reported that the Mexican government will likely proceed with a DST as part of its 2020 budget. And in France, the finance minister has stated that a global solution will replace the French DST, but only if it taxes the value created by data. In regard to trade relations between the EU and the US, there are 2 developments to note. The EU member states have given approval to the European Commission to start trade negotiations with the US. And in regard to the recent WTO ruling concerning US subsidies for Boeing, the European Commission has prepared a preliminary list of US products which might be subject to countermeasures for public consultation. For the Commission's press releases on these 2 topics, please go to our website or app. Meanwhile, the China-US trade war has still not been resolved, although some goodwill gestures are made from time to time. The latest is the announcement by the US to grant an exclusion from a 25% punitive tariff rate for an additional 21 Chinese origin products. For a copy of the US government's announcement, please go to our website or app. And also in regard to China and the US, a WTO dispute panel has issued its report in regard to a dispute which concerns China's tariff rate quotas for certain agricultural products. For a copy of the report, please go to our website or app. In Australia, the tax authorities have issued, for public comment, draft guidance in regard to the deduction of expenses on environmental protection activities. For a copy of the draft guidance, please go to our website or app. In China, the government has announced a pilot tax incentive program in regard to taxpayers which invest in Chinese depository receipts, CDRs, issued by so-called innovative Chinese companies. For a copy of the government announcement, please go to our website or app. In Hong Kong, the tax authorities have issued 2 items of guidance. The first on deductions for a range of matters, including environmental protection facilities, and the second on deductions for R&D expenditure. For a copy of these 2 items of guidance, please go to our website or app. I have 4 cases from India, which I will take you through fairly quickly. The first is Elsevier Information Systems, which was decided by the Mumbai Income Tax Appellate Tribunal. The case related to payments made to a German company for access to an online database of data collated from various chemical journals and articles. The issue was whether the payments constituted royalties or fees for technical services under the India-Germany Treaty. The tribunal held that the payments were not royalties under the definition in the treaty because the customer was not given a right to use the copyright in the material on the database. Apparently, it was not argued that the payments were covered by the for information part of the definition of royalties. And the tribunal held that the payments were not fees for technical services under the definition in the treaty because there was no significant human intervention involved when the customer accessed the database, despite the fact that significant human participation was involved in the construction of the database. The second case is Linklaters, which was also decided by the Mumbai Income Tax Appellate Tribunal. This case concerns whether the taxpayer, a UK law firm, had a PE in India under the Furnishing of Services provision, Article 5(2)(k) in the India-UK Treaty. The key part of that provision says that the furnishing of services within India by an enterprise through employees or other personnel, but only if activities of that nature continue within India for a period or periods aggregating more than 90 days within any 12-month period. In counting the days on which services were furnished, the tribunal held that you count days, not person days. Thus, if 10 employees furnished services on one day, you count one day, not 10 days. And if an employee is on vacation in India on a particular day, then that employee is not furnishing services on that day. On both of these points, the tribunal was obviously correct. The third case is JP Morgan, which was decided by the Bombay High Court. This is a transfer pricing case. The issue was whether the profit markup from an MAP agreement which was concluded between India and the US could be applied in determining the arm's length price for transactions of a similar nature that were not covered by the MAP agreement because they involve group companies resident in countries other than the US. The court held that the MAP agreement can be relied upon in these circumstances. Although the agreement cannot be applied automatically to transactions which are not covered by the agreement, it can be of persuasive value. And the fourth case is Mega Engineering, which was decided by the Telangana High Court. This is a GST case. The taxpayer had both GST output tax and input tax, with a net tax payable. It delayed the filing of its GST return for several months. Due to that delay, the tax authorities imposed an interest penalty on the taxpayer. The interest was calculated on the taxpayer's gross output tax, not on the net tax payable. The issue in the case was whether that interest calculation was correct. The court held that it was. It said that GST paid on inputs qualifies as input tax credits only when the return is filed. By delaying the filing of the return, the taxpayer exposed itself to interest on the gross output tax, even though the return, when it was filed, claimed input tax credits. For a copy of these 4 cases from India, please go to our website or app. In Indonesia, the government has revoked Regulation PMK 210, which was going to provide an e-commerce tax regime beginning on the 1st of April. Thus, the pre-existing law continues. The government said that the revocation was carried out in view of the need for further coordination and more comprehensive synchronization between the Indonesian ministries and institutions. In Korea, the government has announced that the start date for the planned reduction in the rates of stock transaction tax on listed shares will be the 3rd of June 2019. The planned reduction in the rate of stock transaction tax on unlisted shares will probably be included in the 2019 tax reform proposals, which would mean that it should be effective in 2020. In New Zealand, the government has announced that it will not be introducing a comprehensive capital gains tax, contrary to the recommendation of the government-appointed panel, the Tax Working Group. The new tax was opposed by one of the parties in the government coalition. And 2 stories from Taiwan, both dealing with outbound investment. Firstly, the government has proposed a bill which would provide tax incentives to encourage the repatriation to Taiwan of offshore funds. And secondly, the government has issued a ruling which sets out the conditions for a Taiwanese parent company to be exempt from gain recognition if one of its subsidiaries migrates its company registration from one jurisdiction to another. The European Court of Justice has decided a VAT case which concerns incorrect invoices. The taxpayer purchased services from several suppliers who incorrectly included VAT in their invoices. The particular services were required to be subject to the reverse charge procedure. The taxpayer paid the invoices, including the amounts incorrectly charged for VAT, and claimed input tax credits for that VAT in its returns. On audit by the tax authorities, the taxpayer was denied the input tax credits for the VAT incorrectly paid to the suppliers. The court resolved this matter in this way. Firstly, the taxpayer is not entitled to claim input tax credits for the VAT it incorrectly paid to the suppliers. However, the taxpayer is entitled to seek reimbursement of that VAT from the suppliers. And if that's impossible or excessively difficult, for example, because the supplier is insolvent, the taxpayer must be able to address its application for reimbursement to the tax authorities directly. For a copy of this case, please go to our website or app. The European Parliament has passed new rules to better protect whistleblowers who disclose breaches of EU law. But final approval still needs to be given by the EU Council. For a copy of these new rules, please go to our website or app. The European Commission has published the full version of its state aid decision in regard to the UK's CFC rules. For a copy of this document, please go to our website or app. The European Commission has published the documents from the latest meeting of the VAT Committee. If you would like a copy of these documents, please go to our website or app. Here is the list of documents. Please hit the pause button if you'd like to study this list. In France, Google Ireland has been successful in an appeal by the tax authorities against a 2017 judgment. The decision was given by the Paris Administrative Court of Appeal. In the main part of the decision, the court held that Google Ireland did not have either a contract concluding agency PE or a fixed place of business PE in France under the France-Ireland Treaty, despite the provision of services to it by a French group company. Google Ireland was also successful in regard to some other tax matters, including VAT. For a copy of the court's summary and decisions, please go to our website or app. In Germany, remember the concern earlier this year in regard to whether outbound payments for online advertising would be subject to royalty withholding tax? Well, the official position is no. First, it was the Bavarian Ministry of Finance which gave its position. And now the Federal Ministry of Finance has published a letter which confirms the situation. For a copy of the letter, please go to our website or app. Also in Germany, the government has released a draft bill which would introduce an R&D incentive in the form of a government subsidy for qualifying R&D expenditure. For a copy of the draft bill, please go to our website or app. In the Netherlands, the government has launched a comprehensive review of the country's tax system. For the government's information about the review, please go to our website or app. Also in the Netherlands, the government has published the latest annual report on private rulings. For a copy of the report, please go to our website or app. And speaking of private rulings, the Netherlands government has sent a letter to Parliament on its new ruling practice concerning international tax rulings, which will be effective the 1st of July 2019. You'll remember that the government outlined the new practice in a letter to Parliament in November last year. For a copy of this latest letter and the relevant attachments, please go to our website or app. In Russia, the VAT law has been changed to allow input tax credits for VAT incurred in the provision of export services. That is, where the place of supply is outside Russia, unless the relevant export service would be VAT exempt if supplied in Russia. Under the prior law, only VAT incurred in the provision of services supplied in Russia, if taxable, qualified for input tax credit. And in the UK, the tax authorities have issued guidance in regard to who can claim an input tax credit for VAT paid on import of goods. The guidance says that only the importer of record can claim the input tax credit, provided it is also the legal owner of the goods. This means that a toll manufacturer who is the importer of record but is not the legal owner is not entitled to the input tax credit. The tax authorities have stated that they expect compliance from the 15th of July 2019 onwards, but they will not seek to challenge what's happened in the past. For a copy of this guidance, please go to our website or app. Bahrain is continuing to issue guidance in regard to VAT. The latest item is a so-called VAT education booklet, which describes the VAT treatment of educational services and related goods and services. For a copy of this booklet, please go to our website or app. In Kazakhstan, the government has published a law which, amongst many other things, temporarily suspends the operation of the country's CFC rules in regard to a foreign entity which is registered in a country which has concluded a double tax treaty with Kazakhstan. The suspension period is from the 1st of January 2018 to the 1st of January 2020. For a copy of the law, please go to our website or app. In Saudi Arabia, the tax authorities have issued updated guidance on what constitutes an economic activity for VAT purposes. For a copy of this guidance, please go to our website or app. And the UAE has issued guidance on VAT refunds for foreign businesses. For a copy of the guidance, please go to our website or app. In Brazil, the government has published a private ruling in regard to the tax treatment of outbound payments for rights over the sale or distribution of software. The ruling indicates that such payments are subject to 15% royalty withholding tax, but are not subject to various indirect taxes provided some conditions are satisfied. For a copy of the ruling, please go to our website or app. In Canada, the tax court has decided a GST case in regard to the provision of miles under a mileage loyalty program. A Canadian bank made payments to the operator of the mileage loyalty program in consideration for the operator providing miles to the customers of the bank. The operator charged GST in its invoices to the bank. The bank argued that no GST should have been charged, but the tax court concluded that the GST was correctly charged. For a copy of this case, please go to our website or app. And now for this week's treaty developments. We've had 4 treaties signed, 1 protocol signed, 1 note signed, and 2 treaties enter into force. Well, that's the way it is this Friday, the 26th of April, 2019. I'm Steve Towers in New York. Have a great weekend.